Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. Take two, as we had to restart because Lauren had to put her beautiful lights on her background. Lauren, how are you today?
Good. Right in the middle of holiday madness. Kids are out of school. Grandparents are visiting to help with the kids. It's crazy.
I'm feeling pumped because I haven't recorded with you in ages.
Yeah, it's been a while.
So today we are going to talk about our CWS Investments Fund and talk about the past quarter and the past year and where have we gone over the past year, because when we look back at everything, we always are trying to look ahead. But when you do take a moment to look back and reflect, I'll say, Lauren, it's pretty impressive.
Yeah. And I think kind of what we want to touch on today is really like a year in review, right? So we're going to get to what's new in our portfolio, what's changed in the market and in assets we're acquiring. Where on the investor relations side are we with capital and in how many investors and all those fun things. But I kind of want to take it back a little bit and talk about how we got here and how that hasn't changed, the core mission of what we're doing. And it's really fun to see it kind of play out over this past 2 years, but really more aggressively this year. So as most of you may or may not know, maybe this is your first time listening to us. Maybe you've heard us since we first launched the offering almost 2 years ago. So Chris and I both come from the note space. We both invested in notes with our own capital. We were probably sitting in your seat listening to all the podcasts and trying to figure out which direction to go in real estate and generating passive income. Built our portfolios, met at a conference actually, and started working together and collaborating, which then led to this offering, as both of us, Chris more than I, had done some joint ventures with people who weren't accredited, so didn't have access to a lot of the traditional funds that are only open to accredited investors. That's kind of where the Reg A was born, I'd say, is how do we take an asset class that is typically an asset class and a way to invest in that asset class that is only typically available to family offices, institutional investors, and accredited investors. And how do we make it accessible to anyone who wants to get their feet wet with alternative investing, who has capital but isn't accredited? How do we open the doors? And I don't love this term, but I'm going to use it because I know everyone listening has probably heard it. How do we democratize alternative investing? And so that's really where the Reg A came from. And it's been pretty wild over the past year and a half. So we launched CWS in February, essentially, we filed of 22. And then we're qualified to offer this offering, this Reg A, to the public in July of 22. So here we are a year and a half later. And it's been great to see both in the first 6 months of the raise, we, raised $6 million. Now we've tripled that. We're over $20 million in capital raised. But what's most amazing about that is that $20 million has come from everyone, anyone who's wanted to get in and invest and learn what it's like to invest in something that pays you a dividend, that hasn't necessarily had the option to do that, is now able to do that. So kind of running through the investor relations stats, we've gone from 0 to over 500 investors. And now this is the super interesting part, I think. Our reinvestment rate, meaning the number of people who have reinvested into our fund, is 22%. So people are sometimes investing the minimum to start, which is $5K, getting to know us, getting to know how we work, how we operate, do we pay distributions on time, and then come back and allocate anywhere from 25 to 100 plus once they get to know us and our processes and our team a little bit better. So it's been pretty incredible. And before Chris, I know I'm like hogging the mic right now, but I want to share this story. I was running through distributions about 2 months ago, checking everything. We like to get them out on time, if not a day early. And I was going through and I saw an investor's name pop up. And I looked at his investor profile and realized that this investor started with us last December, again, with the minimum investment of $5,000 and has been investing every single month since. So we started with 5,000. And when I checked a couple months ago, when I was going through this process, he was at over $75,000 invested. He went from a small dividend check to over $500 he's receiving a month. And it's just pretty cool to see how he just got started. And every month he would allocate a little bit more, a little bit more. Some months it was just 5,000. Some months he was able to put a little bit more in. But it's that power of that, like consistently showing up and investing and to see his account grow. Like that's, for me, that was pretty incredible to see kind of the impact of someone who started with us and continued to contribute over the last year.
Two stories that I'll say this past year on the investor relations side kind of ring a bell with me is investors who have invested with in the past hear that $5,000 minimum, or you go to somebody and like, it's a $5,000 minimum. And it's shocking to them because they're so used to seeing offerings that are 25, 50, 100,000, 250,000. And like you said, they're like, I can't even get involved into any of this spaces. And it doesn't allow me to diversify my portfolio as much as I'd want to. So that was one. And on the flip side, when I talk to sponsors, we tell them about our offering, they're like, oh, you're nuts. Why would you want 500 investors? Why would you go that route? Because they're only looking at those big ticket investors. Whereas like you mentioned, part of our whole, when we started this was to open up Blue Ocean strategy, open this up to everybody, to give everybody that opportunity to invest, which, based on having now over 500 investors over this past year, like you said, tripling the amount of investment dollars that come in the door, I think that's an ode to you, the investor relations team, and everybody for getting the word out and then working with the investors.
Yeah. And I think you make a good point there. I didn't even think about that. How even if you're accredited, you may not have or want your first investment in an alternative to be a 25, 50, 100K minimum. For example, I'll think about me, like back when my husband and I first kind of hit that accreditation status, that didn't mean we had a ton of extra cash lying around to just go and throw into alts. And even if it did, would we really want to put a huge chunk of our cash into something that we hadn't done before? So it gives people the ability to kind of test the waters, so to speak, and get more comfortable with the idea, because I think alts in general they need a huge like rebrand in terms of when people think of alts, they think of something scary, but that's a whole nother podcast we can talk about. So Chris, why don't you tell us acquisition side, January of this year, where are we now and where are we looking to go in 2024?
Well, thank you. And I'm going to steal one of your lines now because you came up with this, and it is a perfect example of, as we've grown, the relationships we've been also able to grow. And for people out there, the first quarter of this year, we saw approximately like $300 million in assets come across our desk. Second quarter was about 300 million a month. And then this whole third and fourth quarter, we're seeing 300 plus million a week in assets. So clearly the inventory has been ramping up. And when you compare that to the other asset classes, you look at everybody in self-storage, multifamily, triple net lease, all these other asset classes of real estate, there's no inventory. And what is out there is very expensive because of the lack of inventory and a lot of unknowns, because you're playing with interest rates and cap rates that, again, don't correlate or have an impact on our portfolio. So we've been able to see that increase in the market where everyone else has been seeing a decrease. And Lauren, I don't know if you want to chime in and add anything to that.
Yeah, I mean, just that kind of what does that mean? I guess I'll ask you. I know the answer.
Yeah.
But so, okay, we have inventory increasing. What does that allow us to do in terms of our acquisition?
Thank you for that softball, which is it allows us to cherry pick our assets. So when we are looking at buying assets for our portfolio, and this year has been a really interesting year, we topped out at about 125 assets in the portfolio. Now we're about down to 100. And that's because we've been rebalancing where when we were starting out, I'll call it lower balance loans that we have now either exited in some fashion. And then if there's two $50,000 loans, replacing that with a $100,000 loan. So we've been able to rebalance the portfolio while also being able to cherry pick assets specific to our portfolio because of the amount of assets that are available. I was going to say, and just overall, a little bit more about the portfolio. We are still very consistent in just under 30 states. We haven't broadened out into additional states, and we've been in overall about 40 states overall, but the 30 is where we typically do most of our work. The interesting thing when we talk about growth and part of what we really focus on in our portfolio when we talk about cherry picking is those loans that have more seasoning to them, definitely pre-COVID. And what that allows us to do now is when we look at our loan balance compared to the actual value of the real estate, the loan to value is under 40%. Our portfolio has about $55 million of real estate backing the loans that we have. So if there was a catastrophic pricing decline in real estate, we have that equity coverage that allows for slight to even moderate to significant decreases. Whereas, again, when you look at other asset classes, which we'll talk about what we're going to see in 2024, a lot of those asset classes are getting pounded right now because of rising cap rates, which, again, devalues those asset values. So that's something that as we've grown our portfolio, we still follow that balance that we've always wanted and had. And it's actually because of this inventory increase, it's allowed us, I don't want to use the term make it easier, but it feels like it. But I don't want people to think, oh, what you do is easy, because trust me, it is not.
Yeah, I think something that I want to touch upon is, and something that I kind of looking back I'm totally shifting gears now into what we've learned over the past year, that there's a lot of education that we've put into. Sometimes I feel as someone who, again, started investing in alternatives several years back, I always felt like sometimes people were I wasn't understanding all the options and what does this mean? What does that mean? So I think something that Chris and I spent a lot of time on and our team is really the education component of like, what are mortgage notes? How does this work? How do we make money? And as an investor, how are you involved? And from that, so there's the education of like the asset class. And I think there's also the education on things you should be asking when you're going to invest or looking to invest with a sponsor. So I think, Chris, maybe this is just my takeaway, is that, well, I have my own whole thoughts on this and education and financial literacy. It's like a big passion of mine. So I think that's something that unique that I think we bring to the table and we do focus a lot on. Do we have to? No, but I think that our investors and the people that have chosen to invest with us appreciate that. And I think that for people who are newer, and I've had several conversations with investors or people who have kind of crossed that bridge from like reading about us, hearing us on the podcast, watching a webinar, to like taking the leap of faith and investing with us. That was something that they brought up, is there's a lot of education that you guys provide on how to evaluate a sponsor, how to evaluate an asset class, questions you should ask, and then just education about our specific asset class. So to kind of break this down, over 2024, we've done probably over 24 webinars. We've been to 15 conferences between investor relations and asset management, and then dozens of podcast episodes, both educating not just on what we do and who we are, but also what else is out there for people looking to invest in real estate. So I really think in 2024, if I was to look forward, that there will be a bigger emphasis, and I know there will be because we're planning our marketing calendar right now, a bigger emphasis on education around what we do, working with some self-directed custodians to have them explain what a self-directed IRA is. So a lot more in the partnerships that we're going to be doing and exciting stuff coming to the podcast and also to our investor community as a whole.
So one thing that you mentioned about a lot of that education, one thing I think we should be proud about is the podcast overall exceeded 1 million downloads since its inception. So that's a pretty crazy number when you think about it. But you hit the nail on the head on two things when you're talking about education and everything. And sometimes when you've been doing something for so long, you look back and realize how far you've come. And, it was only 7-8 years ago when I learned about a self-directed IRA. And when I learned about it, I was pretty upset that I had moved from several companies and I couldn't do things with it. It all comes back to knowing what's out there. And one of the things that we're also focusing on is the options that are available out there for people, because most people don't know what a Regulation A plus offering is. Most people are just so used to hearing 506C because that's all they read on the websites and think, oh, I'm non-accredited, so I can't get started with, I have to try and go buy a rental. I can't invest passively or I have to invest in the market. So that's one area that we're really focused on. And the other for next year also, like you talked about, Lauren, is that education piece. And also, again, showing what questions people should be asking and what they need to look out for. Because the reality of it is the last 5 years, anybody could have made money in real estate. Real estate we printed $5 or $6 trillion. The asset class just took off. A lot of people got in and like, oh, this is easy. Real estate is not easy. It is a very challenging and is going to be coming up a very challenging environment to get in. And we're already seeing that happen with deals where they started cutting off distributions. The multifamily market, you've seen in the news a lot of issues that have come up with sponsors going under as well. So you're seeing a lot there. It just came out last week that Lennar, one of the largest developers in the country, they're selling 11,000 multifamily units. They're basically like, we're done. We're lost 20 million in the last 6 months. We don't see it getting better. We're going to sell. So
we hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you.
Yeah, I don't know if I'm just going to go there, but so something that's always been interesting to me is when people will ask for what's your track record? And anyone could put anything on an Excel spreadsheet and send it to you. And it's always been a little funny to me. I'm like, anyone can put anything on an Excel spreadsheet. You have to already have an insane amount of trust in this person to then trust that what they're giving you is accurate. Maybe I'm not that trusting, but there is something called a track record verification report. And I'll be honest, this is something that we learned about recently and have implemented because it's a third party that basically verifies that your track record history that you're putting out to the public is accurate. And now moving forward, now that I know that this thing exists and you can get it from KPMG or ACA or one of these bigger names, and it has kind of that validity to it. If I was to go out and invest in something else with a sponsor, I'd probably ask for that. And so there's been a lot of learning as a sponsor on things that I want to do better at for our investors or for prospective investors, and just make it just very clear cut when people come and ask about that. Because yeah, we have a spreadsheet we put together and I know that it's awesome and that the numbers in there are accurate, but to now have a piece of paper that says, hey, this has been verified by a big firm that this is all they do is something I guess I didn't know that we had the option to create. So that kind of leads me into where we've also kind of grown the business in 2023 is we took literally a jump into the broker dealer world. And for those listening, if you don't know what that means, we've basically established relationships with brokers. Okay, so when I say brokers, think Schwab is a broker. So we're establishing relationships to be able to work with the financial advisors to be able to allocate into our fund on behalf of their clients. So this is huge in that people who say have a financial advisor or managed account at one of the brokers that we partnered with will be able to say, hey, like, can you invest in Seveney? Again, there's like 12 different steps between that go into it, as again, learned. But it's just another way that we're expanding our reach to people who want another person to evaluate us and have that stamp of due diligence approval before they invest. So it's not for everyone, but it's been a great experience to kind of work into that side of the business as well.
It's been very educational.
It has. It has.
One thing, it's interesting, I'll touch base, jump back a little bit about that track record verification, because I've been heavily involved with working with the firms on this. And again, I think it just goes back to me just like, oh, this is how, you calculate IRR or whatever it is. And they're like asking me all these questions about like how to calculate things. And I'm like, oh yeah, well, it's based off of, it's transactional based on the dates. I'm like, why? And they're like, oh, well, some people actually like lump everything into like a year at a time. So it's not like a transaction of this happened on this date and this happened on that date. And I'm like, how can you do that? And they're like, you can't, but some people do because it makes a number look better. And then kind of, it's like anything, read the fine print, like buying a car. It's like, oh, starting at XYZ MSRP, but doesn't include steering wheels, tires, or anything else. Similar to some people may, like you said, anyone can put numbers on a spreadsheet. And there's certain ways that it should be calculated, or industry standards, that way things should be calculated, which again, we followed those, but it's just another component of the investment realm that we've gotten a lot more familiar and educated on.
Yeah. Well, I have kind of two trains of thought where I want to go right now. So let's start with looking forward, where you see us going in 2024. If anything significant you think that will change, or whether it's the market or what we invest in, go for it.
Yeah. So I'll give my brief synopsis of the market. And I'll say that because I want to be brief, but also kind of how that plays into what we're going to be doing. The market's very different. I don't see the economy getting better over the next 12 months. It is an election year. So things kind of can also, a lot can happen. But today we have more deals to fund right now. I mean, we see more deals. Like we could fund so many deals right now, but that we're so choosy and picky. We're starting to also see more defaults. Now, as part of those defaults, you may see statistics that say, oh, foreclosure numbers are down, or all these magic numbers that are getting thrown out there. The reason why is borrowers have so much equity, they're filing bankruptcy. That's not included in a lot of those foreclosure numbers. We're also, interestingly enough, we're seeing less competition. And it's people are like, what do you mean? Every time I turn around, there's somebody starting a private credit fund. Yes, but that is also KKR, BlackRock, or $20 billion plus entities that we're not there yet. Yeah, as I say yet, Lauren. But within where we play, we've seen actually a decline in the number of competitors. And part of that is because a lot of them base a lot of their investing on lines of credit, where they had lines with other institutions that would lend them money to go out and buy these loans. And 2 years ago, they would be getting loans at 6-7%. Well, today, all those loans are at 12-13%. So they now have had to shrink their portfolio. So for us, I don't see any major shifts in what we do. Our strategy has always been target focused on staying in notes. I know others started peeling off, not us, oil and gas or crypto, or pick your cup of tea of the day. Short-term rentals was hot for a period of time. No, we're not chasing the shiny objects. We are staying focused in this asset class. Can I add a few more things? Because I can just keep talking. What I will tell people, though, who do listen and are looking to invest in this year, kind of like what you mentioned, I think a lot more people are hesitant of putting 100,000 or 250,000 into these new investments, because there's sponsors out there who have 2 deals, syndications going on, one asset, one deal, that those deals aren't going well, but they're raising money for that other asset now. And people are like, wait a second, I'm not getting my money out of these deals. why would I go into this one? Or people who are looking to allocate money into other investment opportunities no longer can because of, like I said, delays in other asset classes because those assets aren't being liquidated or they've cut distributions. So we're starting to see overall some interesting things shaping up in some of these other asset classes that, again, are significantly impacted by interest rates, which for those who have listened to us talk, we've beat that dead horse 1,000 times on how we go after yield and the interest rate doesn't have a significant impact. So,
yeah. So I want to do kind of like a quick fire question to kind of wrap it up.
okay.
Or maybe like 2 or 3. We'll see. So what you feel most proud of looking back in 2024, biggest win for you?
Oh, so the biggest win for us is our team growth, that we've had the same team intact the entire year. We've had basically everyone has grown, everyone has learned. And, is it easy? Nope. But we've been able to, and the bond that we've formed as we continue to grow has, I think, it's been immensely positive for us in the company.
Yeah, I would definitely, I'm going to answer these as well, giving myself a little bit more time to think about them. But so I would definitely have to agree with that. The team is a consistent win. I'd say the biggest win I feel this year has been the impact I feel like we've had on some of our investors. We receive investor testimonials, not like actual testimonies, but like emails from them saying, hey, this has been my journey from where I started to working with you and what it's allowed me to do because I'm getting X amount to subsidize my retirement or whatever it is, retire early or pay for my kids' daycare. That impact to me has been a big win. And I think another just big win, because I'm on the IR side of the house, is just tripling our capital raise. So tripling the capital raise and then the impact that it's having on our investors. I think for me, maybe I'm young and naive, as some might say, but the impact, the emails that we get from our investors and like seeing the reinvestment rate has been awesome to see and a big win for us. Okay. My second question is biggest lesson learned this year.
I think anybody who's ever managed a business will understand whatever you think the effort and time it's going to take, triple it. If you think something can be done with 2 people over 3 weeks, you better focus on having 6 people over 9 weeks. And I think in the beginning of the year, for the first 6 months of the year, probably we're a little bit more aggressive on certain things, that decisions we made. But as we learned quickly towards the end of the year, and when we had a major shift in software from our accounting systems and stuff, like I look back at that and we knew going into that, okay, let's take what we learned and let's reshift to make sure we have the right resources so that goes smoothly, which it did. So understanding that component from a business perspective is probably the lesson learned. And I'm sure yours is probably the same thing. If you think it's going to take a week, it's probably going to be a month or longer. But I'll let you answer that one, Lauren.
No, I mean, patience is always a lesson I'm continually learning. So I won't say that's my biggest lesson learned. It's a continuous process. I think the biggest thing that I take away or have learned from this year is it's about consistency, communication, and showing up. And I say that in quite a few ways. I mean, consistency with your investors and the communication that you're providing them, as far as like how responsive are you? It's something that we pride ourselves on. Like, what is our response time to investors? Who's answering the phone? Who's speaking with them? That consistency is more important than hitting a home run every now and then. So there's that. And then there's also on the asset management side of the house, same thing. It's like, okay, this is what we do. We are very focused, staying focused and showing up and doing what we know works. Obviously, we want to make things better and iterate on them. But I think it's just about consistency, patience, it's always, and showing up for your investors and your team.
The other thing too that I'll add back into this is highlighting, thinking about our loans, our borrowers, and other things. There's a lot of people out there who are struggling right now and financially trying to make payments. So there's a lot of people out there, and treat them with respect, and where I think what we're very good at is coming up with creative solutions and understanding that not everyone may live the life like you live, or people don't have as much of an advantage, or they might be at a disadvantage in some areas, locations, or skill sets. So understand that and basically try and come up with solutions. So that's one thing that everyone's always focused a lot of times on their self and their growth and trying to understand that process, but also look around and be thankful, because there are a lot of people out there who, especially as we are in the holiday season, are not as fortunate.
Yeah. And my last question is, and this is a big one, I mean, like, you're putting it out there on the podcast, is what is one thing you hope to accomplish in 2024?
Well, I always do a year-end prediction, or what's going to happen next year. And actually, I think I've been somewhat accurate.
No, but this is for you. This is like your goal for the company, for yourself for 2024. Looking back a year from now in 2024, December 18th, 2024, what do you want to say on the podcast?
That we are, again, more than doubled our size next year and are now over $50 million within our fund.
Okay, answering that myself, I would agree with that as far as like doubling the size, if not tripling the size of our fund. But also, and this kind of goes, I guess, to what I learned as well, is that continued kind of trust in our team. Like, I want to look back a year from now and be like, wow, our team, and we have this now. And I think that's been like so awesome to see. But to that continued growth of everyone kind of being on the same page, working together. Yeah.
I like to look at, again, being a sports fanatic, you look at a company in a year over time is like going through a season in any sport. Basically, as the season moves on, the team grows and the bond grows stronger, and people understand, can work off and feed off of each other. And as that continues to happen, you continue to get a lot better. And that's where I think we've been over since we've been together now for several. I mean, we go back well before the 2 years mark and so forth. So we've grown a lot.
I would also now, if I'm like thinking more about this, because again, these are quick fire responses. And now I'm like, oh, I have another thing. So I would love to double our investor count. And I say that because if we can double our investor count, then that means that more people who typically have not had access to this kind of investment will have experienced passive income, or whatever, mailbox money, or whatever you want to call it, what it's like to invest in an alternative. So for me, doubling the investor count, and I don't know how I would know this, but hey, if you're an investor and you're listening to this and this, one of these things has happened to you, feel free to email me, because this part of why the mission behind why we started the Reg A, but more people who are like, hey, this is helping pay for my kids' daycare. This is helping me pay off student loans. With inflation where it is, to hear those things makes it like more impactful in a way for me. So again, I don't know how I'm going to measure this. I'm not going to send out a survey to all of our investors and be like, what did this help you do? But how I'm going to measure it is, if we can double our investor count, that's twice as many people we're able to impact positively in whatever way that helps their lifestyle, whether, again, that's retirement, loans, paying for kids stuff, whatever that is. So yeah, that's important to me.
Cool.
Any
final thoughts?
Yeah, I don't have any final thoughts. Excited for 2024, and we'll see you in 2024.
Thank you all. Take care.
Thank you. Bye.
Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.